Welcome back to another episode of the Wealth Alchemist. I've got Shane Keith here with me again today. And today we want to talk about long-term care. We're going to get a little more technical and detailed, whether you already have long-term care insurance or just wondering what it is, or if you've looked at it before. What are some of the pieces that make up long-term care, and what are some considerations you'd look for in a policy?
Should be a fun conversation today.
I'm looking forward to it. First things first, why you would ever even consider long-term care. It really gives you assistance with your activities of daily living. There's 6 that policies look at. That's bathing, dressing, eating, transferring, toileting, incontinence. And that care can occur either at home, assisted living, memory care, or even in a skilled nursing facility. So there's a pretty broad breadth of what can be covered through long-term care. But why might someone look to purchase a policy?
Well, from a statistical perspective, your biggest expense in retirement is typically healthcare related. With that being said, long-term care is usually the driving factor of that, especially if you're considering a married couple, right? You may say, hey, we're going to take care of each other. That works on one side, right? Usually one of you is able to take care of the other, but then what happens for the surviving spouse? So I think there's a lot of consideration of why you should look at long-term care. And there's usually an age window of when it's most appropriate to consider. You can get to a specific age, it gets really expensive to consider. And also, of course, health concerns are another factor that drives that cost. With that being said, we could take a deeper dive into the types of policies that are offered today and how they use activities of daily living, along with what type of care they offer. You mentioned 3 different home health care versus in-home care, nursing home care, and how each policy can be customized to fit exactly what you're looking for.
We look at lots of different policies that have been sold for a long time, and we do a review on existing ones. And there's definitely pieces that make a policy better or worse than others, especially in particular cases. We want to make sure that this policy works for you. So there's 2 main structures that long-term care is sold on today. There's a hybrid structure, and then there's the older style traditional long-term care. What's the difference between those 2?
Yeah. If you fall into the Gen X generation or even a millennial generation, you've probably seen the traditional long-term care with either your parents or grandparents. Traditional long-term care, think of it like old school insurance, like auto insurance. You pay for it every month, and if you don't ever use it, it just goes away, right? If you never need it, still those premiums are gone. I would say Genworth is like the company known for traditional long-term care. John Hancock has a lot of old school policies as well. I just bring those 2 up because if you're familiar with traditional long-term care, you've probably had a poor experience with, hey, my parents are getting up to the age where they're going to start to need it, but now they're getting letters in the mail that says, hey, my premiums are going to double, meaning I have to keep paying. I got to pay way more on a monthly basis, or you can get much less benefit when it's needed. And so they're either making you pay more premiums or reducing your benefit. And that's because a lot of these companies were not prepared for how quickly healthcare expenses were going to inflate in the United States over the last few decades. So healthcare costs and healthcare inflation is actually one of the higher inflationary numbers of any sector out there. So that's old school, traditional style insurance. It's not something, at least within KDI, that we believe is usually the right fit for people. We'll look at it and entertain it, but these new updated hybrid policies, in my opinion, are much more applicable to consider for long-term care need. They're called hybrid because they're a life insurance policy with a long-term care rider. They ultimately have a death benefit. So you pay a specific premium into them, and most of, if not all of that premium gets paid back out in a death benefit if you never use it. I've seen policies where it's about 80% of your premium comes back in a death benefit, or close to 100% comes back in a death benefit, depending on the year that you pass away. That's one pro that I like of the hybrid. Almost all the money you put in comes back to your estate or your heirs if you don't ever use it. Number 2 on the hybrid is it's a contractual agreement. Here's the agreement promised. You pay X, you get the benefits Y. And so no changing factors happen. So it doesn't matter what happens 20 years, 30 years down the road, this contract is set in place, which gives you much more certainty. And especially from our financial planning side, when we're planning over your lifetime, we are certain of what benefit you're going to get. There's a lot of other factors to consider with long-term care, especially when we're looking at a hybrid policy. You're able to customize it a little bit more, as I mentioned earlier. You can look at interest, a simple inflation rider or a compound inflation rider. We typically will use somewhere in the range of 3 to 5% compound inflation rider. That means it's going to compound on top of itself year over year, which helps your benefit keep up with rising healthcare costs. You're able to structure these to where you can do one full lump sum payment, or you can do a payment over a 5-year, 10-year period of time, call it 10 pay or 5 pay. I would say long-term care is an expensive insurance, but if the need is there, you'll be super grateful that you paid for it. Other things to consider with long-term care, we talked about activities of daily living. Typically, a good common policy today is you need to meet 2 of 6 activities of daily living to qualify for the benefit. So if you can't do 2 of the items that Dylan mentioned earlier, or have some sort of cognitive impairment, those typically are the reasons why you qualify to be able to turn on the benefit and have it pay. These policies can be structured in a 2-year, 4-year, 6-year, or unlimited lifetime benefit. As you can imagine, a lifetime unlimited benefit, that's going to be the most expensive. You're trying to cover, if I live in long-term care for 8, 9, 10 years, those are very rare cases. Typically, if you have a long lineage of Alzheimer's or dementia in your family, those can come into play where you're going to be in care for a lot longer time period. The national average is around 2 years where you would be in long-term care. We build out policies, speaking broadly, but somewhere in the range of 4 to 5 years is usually the long-term care policies that we would look at based on your situation. And of course, all that can change depending on your specific situation.
One of the other levers that we can look at adjusting when we're looking at a policy is the elimination period. Why would we want to consider changing that? What is that?
Yeah, elimination period is typically the time frame that the insurance company requires until they're willing to consider the benefit to turn on. You want to get that compared to Medicare, if you're on Medicare, and see maybe how much of that elimination period you may have to pay for out of pocket. I would say normal 60, 90, or 120 days are what I've seen on policies. We typically like to lean towards the 60 or 90-day elimination period. One thing I didn't touch on is death benefit and it being somewhere in the range of 80 to 100% coming back to the family member, your heir, if you were to pass away. But the real benefit is that the ROI, if it turns into your return on investment into true long-term care, the compounding and what it pays out to you is substantially more than what you ever invested into it, depending on when it turns on. That is why we consider long-term care. It also brings a lot of peace of mind knowing that we have long-term care in place. God forbid something happening to me or my spouse, that insurance is there and able to protect the estate from a massive drawdown, right? Because if you're going to talk about what could impact your financial plan, right now, I believe the national average for monthly care for long-term care is around $6,000 a month. That's like baseline. You get into memory care or you get into needing nursing care around the clock, 24/7. We've had clients paying in the range of $19,000 to $20,000 a month per person for long-term care needs. So there's definitely a need for long-term care. Hey, do I qualify for long-term care? Things to consider. You would go through a medical consideration. They'd want to know some of your medical history that can get you approved or denied. Of course, we could do all that vetting ahead of time with our specialists just to make sure that we're going with the right firm and the firm that could possibly give approval. But the other route with long-term care is like, hey, if we're not going to do long-term care, typically what we're building into a financial plan is what would a self-pay look like? Now we're going to say this is going to be a part of the plan. Can my financial portfolio support if we either one of us or both of us need to go into long-term care?
And I like he said self-pay and not self-insure with the difference there.
Yeah.
We hear that a lot, and it by definition is not insuring if you're self-paying it.
Typically, if we're going to insure something, we are removing the risk from the portfolio. With the self-pay, you will be paying for that out of pocket. So that was with intention.
And with that, the inflation piece, it's growing very quickly, those costs. What do we look at KDI as a terms of how much of that cost do we want to insure away with a long-term care policy? Or is it really by preference? What do you look at there?
That's a great question. When we're doing a comprehensive financial plan for you, we're still going to consider, hey, you have a pension, you have a social security, you have annuity income. We're going to consider that if all of a sudden we're going to care, what assets, what fixed income do they already have coming in that's going to help support this, along with long-term care? You do need to be careful here, depending on an insurance agent or who you're working with. I've come across a couple times where they're shopping the policy where it looks like a Cadillac policy. Yeah, it's also a Cadillac commission to whoever's selling that product. Is that for the sake of they're selling you, well, hey, you're never gonna have to worry about long-term care. Yeah, you're never gonna have to worry. Plus, you're probably never gonna need it that much ever. And so we be very mindful. We don't ever want to overinsure. We're always going to look at it as, hey, what do we have as a fixed income? What is going to likely the need going to be? We think that healthcare costs are going to be about this in 20 years. There's a lot of statistics out there based on what we've seen healthcare grow. That's where our comprehensive financial planning comes into play. And we will work backwards from where we think we need based on your incomes plus protecting your portfolios and work backwards from there.
Again, that ties into leaving the legacy behind and making sure if you want to leave a bulk of your assets to your kids and you're planning on leaving them X amount, we might change that decision as well. But it also really becomes personalized at that point. That's really what I got out of that.
You're spot on there. It, of course, is client specific. We have clients who don't ever want to worry about long-term care and they want to insure away 100% of the risk that they could possibly incur there because they want to protect their portfolio. And we have others that are doing it like, hey, purely out of a financial planning consideration, how do I protect X amount of my portfolio? How do I know that I'm not going to have to go into pocket too much with a long-term care need? Or, hey, I want to live in a really nice facility if I'm going to go into long-term care, and I have a preference in how nice or how well I'm taken care of. We can build plans around those ideas as well. So it is very client specific, but with the new hybrid policies, and with where long-term care has evolved into, we can customize and make it individualized for that person.
And the last question, if you have an old policy that you haven't looked at in a long time, are there potentially some options that we could look at for those policies to see if there's any room for improvement?
Yeah, 100%. And not just long-term care policies. If you have old annuities that you bought, whoever knows how long ago, and you're like, well, I don't know if I have a need for this anymore. Any type of annuity contract, long-term care contract, whole life insurance policy, universal life insurance policy, and you bought it some time ago and you don't really know how it fits into your overall portfolio, bring it to your wealth manager and let them do a second opinion and review. Give us a call.
Well, that wraps up. We wanted to explain some of the details of the long-term care and why you might want to use it. Thanks for tuning in today, and we'll see you next time on the Wealth Alchemist. Bye, everyone.
Thank you all.